Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. I'm Michelle, and welcome to Through the Noise podcast. Following the U.S. President-elect Trump's victory earlier this month, he has named most of his top cabinet appointees as he prepares to hit the ground running on day one, with all eyes on the announcement of a Treasury Secretary now. Given Trump's advocated pro-growth policies and increased protectionism to sustain the U.S. economic expansion, what are the investment implications from his cabinet formations? To discuss this and more, I'm happy to be joined by Manpreet Gill, our Chief Investment Officer of AMEE. Hi, Manpreet. So over the past weeks, we've seen Trump's cabinet gradually forming. How is the progress for now, and what messages do you see from Trump's cabinet pick overall?
Hi, Michelle. Thanks for having me. Indeed, Trump, being a second-time president in the US, will have 4 years to deliver his plans to shake up America and indeed the world. Now, Trump's choice of China hardliners suggests that he appears to be serious about using his tariff tools early on. The aim here, of course, is to curb US imports and the budget deficit, boost exports, and coax overseas manufacturers to relocate to the US, and possibly use tariff proceeds to partly pay for proposed tax cuts. Now, some of the cabinet appointments are controversial, could face some pushback from the Senate, although here the secure Republican majority and Trump's own emphatic victory by popular vote should help get most, if not all, of his nominees approved. Now, following the appointment of known China hawks such as Marco Rubio and Pete Hegseth last week, Trump nominated U.S. financial services firm Cantor Fitzgerald CEO Lutnick as Commerce Secretary, with the additional responsibility for the Office of the U.S. Trade Representative. Now, Lutnick's close ties with the business community should help further Trump's agenda to boost U.S. competitiveness through tariffs and attracting overseas businesses to invest in the U.S. His department also oversees federal allocations for semiconductor manufacturing. However, to counter the negative effects of tariffs, Trump does need a business-friendly Treasury Secretary who likely focus on enacting tax cuts and financial sector deregulation relatively early in his tenure. His choice also of Wright, who's a pioneer in the U.S. shale revolution, as his energy secretary, also raises the chances of a significant boost to U.S. energy output, which should help offset some of the inflationary impact of Trump's proposed policies.
Got it. So given the U.S. Third quarter earnings seasons are now largely over, and also under the current political backdrop that you just mentioned, what are your views currently on the U.S. equity sectors?
Well, the financial sector has been the top performing equity sector so far in Q4, and that's been driven by deregulation expectations under a future Republican government in the US and strong Q3 earnings, where we had about an 8.7% positive earnings surprise. And on the other extreme, healthcare has been the worst performing sector, with a few high profile misses in obesity drug sales. Furthermore, building on the previous question, the expected appointment of Kennedy Jr. as the health secretary is unsettling investors, given some past comments which suggest he's opposed to vaccines and obesity drugs, amongst other issues. Now, looking ahead, we continue to be overweight financials, as it would benefit from expected deregulation and a pickup in investment banking activity as the U.S. economy settles into a soft landing. We also expect growth sectors of technology and communication services to outperform the broader market over the next 6 to 12 months. Artificial intelligence investments continue to support chip makers and software providers who are using AI to enhance efficiency and upgrade their products. Now, the technology sector is expected to deliver the highest earnings growth in 2025, so expectations are just over 20%. The demand for online entertainment would also support strong earnings growth for communication services, which is also a little more reasonably valued. Our preference for the healthcare sector to provide defensive exposure as part of a barbell strategy is undoubtedly being challenged at the moment by the uncertainty in government policy. So we'd refrain from adding further for now to this sector unless we get a bit more clarity on the earnings outlook under the incoming US government.
Okay, got it. So moving into Europe, currently market is expecting the ECB to cut rate below 2% by the second quarter of next year. So what are the implications for Euro government bonds?
Well, we're actually positive on euro area government bonds. So this brings into focus our existing opportunistic buy idea on euro area government bonds on a currency hedge basis. And that, of course, feeds directly into anticipated interest rate cuts by the European Central Bank. Now, euro area economic data has been weak. While inflation continues to trend towards 2%. So this supports the ECB's course of action of further cuts. The market expects another 25 basis point cut by the ECB in December, along with at least four more cuts through 2025. Now, this contrasts with market expectations of the risk of a hold by the US Fed at its December policy meeting. So, in our view, that, of course, on balance, makes euro area government bonds more attractive. Recent political issues in Germany, interestingly, have also not led to any significant volatility in German government bonds. So we'd really view any rebound in euro area bond yields as an opportunity to add to euro area government bonds, of course, most importantly on a currency hedge basis, especially if any such volatility is led by German government bonds, because we expect the ECB to keep cutting rates to support growth. I think the only risk to our view, of course, is if we get any unexpected resurgence in inflation in the euro area or unexpectedly strong economic growth, but neither seem likely at this point in time.
Okay, so the last question here is on Asia. We see that Indian equities and also their onshore bonds have come under some pressures lately. And besides of that, we also see the INR touched a new all-time low against the dollar, driven by sharp rise in the US bond yields and also expectations of a delayed RBI policy easing because of spike in domestic inflation. So overall, what is the outlook for Indian assets for now?
Well, you're right. I think headwinds are undoubtedly there. I mean, the MSCI index has slipped into what, in market convention, at least we call correction territory. So it's falling about 11% from its September peak, and from a technical standpoint, reaching its 200-day moving average as a technical support. Now, while that picture points to the possibility of a little bit more downside for now, the market does appear quite oversold from a short-term perspective. Now, in our view, from an equity for Indian equities, we do expect volatility to remain a little elevated over the next 1 to 3 months because investors are likely adjusting to the normalization of growth in corporate earnings delivery compared with the very strong pace that we experienced last year. And of course, as you just outlined, the RBI's policy outlook. Over a 6 to 12-month period, though, we still see this correction an opportunity to average into Indian equities because in our view, the economic growth still remains well supported, as does the corporate earnings cycle. We also expect India's economy to be relatively less vulnerable to the impact of any potential global trade disruption, given that Indian exports to the US remain a relatively small share of US imports. Furthermore, the quantum and pace of outflows by foreign investors is likely to moderate in our view, as foreign investors' positioning is already quite low, compared to history. Now, that's of course on the equity market. I think the long term, of course, an opportunity to average in. On the rupee, the recent surge in rupee bond yields could be an opportunity to build moderate exposure to medium and long maturity bonds because we do expect yields to eventually move lower on both positive government bond demand supply balance and eventually some central bank easing led by, of course, Fed rate cuts and the RBI potentially following suit early next year. Now, the currency on its own undoubtedly has come under some pressure, but it's important to take the perspective that it remains one of the least volatile currencies compared to its major emerging market peers so far in 2024. So we expect the dollar INR currency pair to remain relatively resilient and trade around the 84 level over the next 6 to 12 months. And supportive factors there, of course, being robust economic growth, fairly stable external accounts, what we've seen improving investor flows so far, particularly in bonds, and of course, what are strong currency reserves.
Got it. Thank you so much, Manpreet, for the insightful sharing. So, in summary, we continue to be overweight on US sectors like financials, technology, and communication services under the backdrop of ongoing AI investments and also a pickup in investment banking activities. On top of that, we also maintain our opportunistic buy idea on euro area government bonds and anticipating further interest rate cuts by the ECB. Whereas on India, while we expect volatility to remain elevated in the near term, we're quite positive on a 6 to 12-month period in the region, given that its insulative nature to global trade disruption. And also, we see that the recent surge in Indian rupee bond yields could be an opportunity to build moderate exposures to a medium and long maturity bonds, while we also expect the dollar rupee pair to remain quite resilient. So thank you so much for listening. And with that, we'll close off this week's Through the Noise podcast. See you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.